Fed wraps up its two-day meeting this afternoon. Our next guest expects Operation Twist, which would allow the central bank to shift its portfolio from short-term treasuries to longer-term holdings. David Semmens is with us now from Standard Chartered. He's an economist. He's also a Bloomberg vest because data show he is one of the most accurate forecasters on the U.S. economy. David, thanks for joining us from London this morning. What would the longer-term rates, if the Fed does go with Operation Twist, actually accomplish in the near term for the U.S. economy?
I mean, I think we're going to see very little effect on longer-term rates. You might see the 10-year edge down a couple of basis points, maybe 5 or 10. But we're really looking for longer-term investment to be driven here. It's not really a question about getting rates lower. The market's fully expecting this to happen. So the rates have already fallen. We're really looking for the longer-term growth to be driven by lower rates.
David, given the fact that longer-term rates have fallen, is this going to be a buy-the-rumor kind of situation, similar to what we saw play out with QE2, where the rates fall in anticipation of the Fed's action, but then when the Fed actually steps into the markets, the reverse happens?
Well, I think rates are also very low simply because you've got a very dire outlook for growth. We're expecting inflation to come off over the course of the next 6 to 9 months. So there are many reasons for rates to be low already, but really the Fed is going to be stepping in to keep those rates low. And also they're going to be moving from the shorter end of the curve to the longer end of the curve simply to start pushing further out because, as we've seen, rates on the short end can only go so low.
Well, what kind of success can we anticipate the Fed would have in keeping those rates low when it wasn't able to keep rates low through the QE2 period?
Well, the reason that rates came up in QE2 was because that, again, had been fully flagged. But people felt far more optimistic about the turnaround in growth. And also people were concerned about inflationary fears. Whereas this is not going to be an inflationary issue. It's going to be the balance sheet is going to stay as it is because you're going to be taking the shorter-term securities and letting them mature and also selling them and moving that into the longer term. So the balance sheet is really not going to have any effect, which is going to keep the hawks on the Fed happy. They're going to be very concerned about stoking inflationary fears. And when you keep the balance sheet at the same size, the argument isn't really there.
So, David, you don't think then that the Fed is really playing with fire?
No, I don't. I think the Fed has got to remain focused on growth. If you go into a deflationary spiral and you have unemployment rising again, then everyone is going to ask, why didn't the Fed act? Why didn't the Fed do more? Whereas this way, the Fed is doing more. And if we do end up with stronger growth and we do see unemployment start to come down, and then perhaps we have inflationary pressures, then you can deal with those inflationary pressures by raising rates. The fact of the matter is we can't lower rates anymore. The only thing you can do now is further quantitative easing, which would be the next logical step if this doesn't work. So
that's what we should expect if, in fact, Operation Twist, however long it's given to run, doesn't actually pay off.
I think what you really got to look for is how happy would the Fed be doing further QE? And what they're really going to be looking for is inflation expectations to edge down and to see the core inflation also start to drop off. Now, we're looking for core inflation to start dropping off during the fourth quarter. It's risen the last 8 months straight. Now, you're going to expect it to keep edging up a little bit higher simply due to base effects. But given the weakness in the US consumer, you're not going to see inflationary pressures being passed on to the core much longer.
David, thank you so much. David Semmens joining us there. He is an economist at Standard Chartered, joining us there from London.